So welcome all to today's class. As we start as usual, as a routine, let us type our details in the chat so that when we start, we only use the chat for questions. So take a minute to type your details in the chat so that we are in a position to start. Type your details in the chat so that we can start today's class. Let's type our names, phone numbers, and the sponsor in the chat so that we can start. So welcome to today's class. I want us to look at chapter 9 straight away to chapter 9. So last time we looked at activity-based costing, which was chapter 8, or alternative costing techniques. So we are moving forward to chapter 9. Chapter 9 is called cost volume profit analysis. So that is where I want us to start to begin with. I'm seeing some people are still typing. Okay, let's just continue. They'll get us along the line. So we were saying in this case, normally as a company makes a product, maybe our business sells loaves of bread. Our business sells loaves of bread, or let's even use sell of chairs. If we are in a business that sells chairs, we want to look at the cost of making chairs. We compare it to the number of chairs sold and the profit that is made from the chairs. There is a relationship that exists in those three variables. The three variables, cost, volume, profit, are what? Related. So that is where maybe I'll start in my introduction. So in my introduction, so as we start in my introduction, I'll say the three variables, there is a relationship that exists between cost of a product, comma, the number of units sold, and the profit that is made. So there is a relationship that exists between what? The cost of a product. So the keyword there is cost of a product, the number of units sold or produced, number of units sold, that is the volume, and the profit that is made. So that is, in this subject, we want to look at the relationship that exists in that. Now, when we are looking at this relationship is measured by looking at the following variables. So that relationship is measured by looking at a number of variables. So looking at a number of variables, and our first variable is what is called contribution to sales. Contribution to sales, that is abbreviated as CS ratio. Number two, we have what is called break-even point. Break-even point in what? Units or revenue. In units or revenue. And in revenue here, we are talking of in Rwandese francs. So break even point in units or in revenue. Number 3, there is something called margin of safety. So margin of safety, it can be in units or percentage. So it can be in units or percentage. And lastly, what we are going to look at is what is called sales units. Sales units to achieve target profit. How many units must we sell in order to achieve a certain profit that we set? So in all these factors, we are going to divide our work into 2. So we are going to basically divide our work into use of number 1, number A, formulas, and number B, we will look at graphs. So we'll be looking at both formulas and also use of graph. So by use of, so I can talk of by use of either formulas, or we can also use graphs. So whichever the examiner asks, you can use any. So I want us to slowly and step by step look at the following ratios. What are the ratios we want to look at? Contribution to sales ratio. Number 2, break even point. Number 3, margin of safety. And number 4, sales units to achieve. Yeah. So let's start with number 1. A, by use of, so CVP analysis by use of what? Formulas. So CVP analysis by use of formula. That is where we want to start. Remember, we have said you can either use formulas or you can use graphs. You can either use formulas or you can use graphs. But I want us to start with CVP analysis by use of graphs. So the primary formula to be used is MC formula. If you remember chapter 7, MC formula. What was MC formula? Remember, MC formula was selling price per unit minus variable cost per unit. I hope everyone remembers this formula, times sales units minus fixed cost is equals to profit. Please master, memorize whatever you use. That formula is extremely, extremely important. So that formula is very, very important. So please remember that formula. That is the formula that we'll be using throughout. So why don't we start with number 1? Number 1, we start with what is called contribution to sales ratio. Contribution to sales ratio. So that is our starting point, contribution to sales ratio. So contribution to sales ratio is equals to C, it is always abbreviated as CS. So in other words, CS ratio. CS ratio. So contribution to sales ratio is given as contribution that a business makes times, just a second please. So sorry, I was attending to an important issue. So contribution to sales ratio is equals to contribution of course times 100 divided by sales that the business makes. So if you want to get contribution to sales ratio, that is the formula. So what is contribution to sales ratio? Contribution to sales ratio is equals to contribution divided by sales. Contribution divided by sales. Now, please let's look at this and understand what I'm saying here. Now, this is calculated also as is equals to selling price per unit minus variable cost per unit, of course, times 100 divided by selling price per unit. It can be shortened like that, selling price per unit. So you can shorten the formula as that. So contribution to sales ratio is equals to, so this second formula is what? This and this, of course, when we eliminate it gives us the same item. So this is the formula that I want you to remember. Contribution to sales ratio is equals to selling price per unit minus variable cost per unit divided by selling price per unit times 100. So this is the first formula that we have learned. What have we learned? Contribution to sales. Allow me to just finish with the formulas so that we take the little time possible, so that when we finish with that is when we go to examples and we end the class. So in order to get contribution to sales ratio, it is selling price per unit minus variable cost per unit divided by, so C is contribution. So when you take selling price minus variable cost is contribution divided by selling price, that is CS ratio. That is not commonly tested. So the second item is what is called break-even point. Break-even point. Break-even point is normally abbreviated as BEP. Break-even point. So when we talk of break-even point, this is the point where the business does not make any profit or any loss. The point where the business does not make any profit or any loss. The point where the business does not make profit or any loss. So we are trying to say at BEP, comma, total revenue is equals to total costs. So at BEP, total revenue is equals to total costs. So at BEP, at break-even point, total revenue is equals to total cost. So at BEP, total revenue is equals to total costs. Okay. Now, suppose we go to our formula that we learned previously, but now I want us to look at break-even point in units. Break-even point, that is BEP in what? Units. So that is where I want us to start. Break-even point in units. So how do we get the break-even point in units? So in order to get the BEP in units, you know that selling price per unit minus variable cost per, I'm just starting from where everyone knows. Variable cost per unit. So times sales units, sales what? Units minus fixed costs is equals to profit. Is equals to profit. Now we are saying break-even point is the point where the business does not make any profit or any loss. No profit, no loss, in short. No profit, no comma, no loss. So there is no profit, there is no loss. So here it will be equals to 0 profit. So at BEP, this is what we are trying to learn. At BEP, there is 0 profit. So we can make these sales units the subject. This one. So make sales units the subject. Make sales units the subject. The subject to get what? To get BEP in what? Units. So to get BEP in units, we just make sales units the subject. So if we make sales units the subject, we can write that sales units. So in other words, BEP in units is therefore equals to fixed costs divided by selling price. I will explain everything, don't worry. Selling price per unit minus variable cost per unit. So that is the formula that we are now learning, but I will explain how that formula is generated. So in other words, if you want to get your break-even point in units, you just identify what is your fixed costs. What is your fixed costs? And then you divide by selling price per, you just make this the subject. So suppose we make this the subject, what will we do in that case? If we made that the subject, I'll maybe make this to be very small. So I'll say selling price per what? Unit minus variable cost per unit times, okay, times what? Sales units. Sales units is equals to fixed costs. I'm taking fixed costs the other side. Is equals to fixed costs. Now I want to remain with only sales units. I want to remain with, sorry. I want to remain with only sales units. If I want to remain with only sales units, I will continue by saying sales units is therefore equals to, you'll divide every side by that. You'll divide to remain with sales units, you will divide every side by that. Sales units is equals to fixed costs. Fixed costs, I just divide each side by selling price per unit. Divide by selling price per unit, selling price per unit minus variable cost per what? Unit. Variable cost per unit. So here is divide by sign. There is a divide by sign there. So maybe if I insert symbols and I look for divide sign, so I look for divide sign, so that is what we have. Please take note of that. So what am I trying to say? Therefore, to make sales units the subject, make sales unit the subject to get BEP. So in other words, sales units is equal to fixed cost, divide both sides by selling price per unit minus variable cost per unit. It leaves you with this as the formula. So what is the formula? That is the formula that we need to learn. So the first formula we have learned is this. This is the first formula we have learned. And this is the second formula we have learned. So what is the second formula we have learned? Break-even point in units. Break-even point in units. Break-even point in units. Next, we have number 2, break-even point. Break-even point in what? Revenue. In other words, in Rwandese francs or dollars or whatever currency. Break-even point in. So break-even point in revenue. So remember, what is a break-even point? Break-even point is the point where the business makes no profit. It does not make also any loss. No profit, no loss. So suppose we are now looking at break-even point in revenue. So in this case, break-even point in revenue, normally abbreviated as BEP, in, of course, revenue form, or BER, some books call it BER, is equals to BEP in units, BEP in units times selling price per unit. So if you want to get the break-even point in revenue form, break-even point in revenue form is equals to BEP that we have shown the formula previously times selling price per unit. Some books also tell you BEP in Rwandese francs is equals to fixed cost. It gives you the same answer anyway. Fixed costs divided by CS ratio. Whichever formula you use, it gives you the same answer. So if you decide to use the first, so it can either be or that. So whichever one you use, it gives you the same answer. So whichever method you decide to use, there is no harm. It gives you the same answer. It gives you the same answer. It gives you the same answer. Okay. My microphone is okay. It is not muted. Can somebody else confirm that microphone is working? Is it working? Just type yes. Those who can hear me. Frank, my microphone is very good. Thank you. It is working. So Frank, check on your mute button or your microphone button. So it is okay. So we are saying that there are two ways of calculating the BEP. You can calculate the BEP either using that route. So you can calculate either BEP times selling price per unit or fixed cost divided by CS ratio. So that is break-even point. So what is break-even point? Break-even point, this is a point where the business does not make any profit or any loss. Let us continue a step further. So that was number 2, break-even point. Number 3, we have what is called margin of safety. Safety. How do you write safety? Margin of safety, normally abbreviated as MOS. Margin of safety, normally abbreviated as MOS. So margin of safety, MOS, is the difference between target, in other words, budgeted, sales units and the BEP units, of course, and the BEP units. So margin of safety is the difference between target sales, the sales that you target to make, and the BEP. So in other words, these are the excess units that gives the business a profit. The excess units that gives our business what? A profit. Remember, for example, if BEP is 1,000 units, when you sell more than 1,000, you make a profit. When you sell less than 1,000, you make a loss. So for example, if the BEP is 1,000 units, please understand the background well. If the BEP is 1,000 units, when you sell more than 1,000 units, you make a profit. When you sell less than 1,000, you make a loss. When you sell 1,000, you don't make any profit or any loss. So for example, if we sell 1,200, the excess units over the BEP is 200. So these 200 units are the excess units that gives the business a profit. So 1,000 units does not give the business a profit, but the extra 200 is what gives the business a profit. So margin of safety in units is therefore equals to budgeted sales units minus BEP units. Please take note of that. Take note of that. So margin of safety is therefore equals to, so this is margin of safety. Maybe I have it as number 1. So margin of safety in units is therefore equals to that. Number 2, margin of safety can also be calculated as a percentage. So margin of safety as a percentage will be equals to budgeted sales units minus BEP divided by, of course, budgeted sales, everything times 100. So margin of safety is equals to budgeted sales minus BEP divided by budgeted sales times 100. And where I talk of budgeted sales, I'm referring to budgeted sales units, of course. When I'm talking of BEP, I'm also talking of BEP in units. So I'm referring to budgeted sales units, and also I'm referring to BEP units. That is what I'm referring to. Divided by everything budgeted sales. So take note of that, please. Take note of that. So margin of safety, you can either calculate margin of safety as a percentage or in units. So if it is a percentage, you know the formula. If it is a percentage, you know that this is the formula. If it is in units, you also know the formula. I hope we are together there. So that is margin of safety. Finally, I will come back to those formulas. Finally, we have number 4. Number 4, we have sales units to achieve. Most of you did this in undergraduate. So this is always the easiest topic, by the way, in management accounting. The easiest topic in management accounting. Sales units to achieve target profit. In other words, I want to make a profit of 1 million. If I want to make a profit of 1 million, how many units must I sell in order to make a profit of 1 million. If I want to make a profit of 10 million, how many units must I sell in order to make a profit of 10 million? So what is it called? Sales units to achieve target profit. Sales units to enable us achieve target profit. So in other words, we go back to the primary formula. Okay, instead of repeating and repeating and repeating, why don't I go to this formula? This formula, you should be familiar with it. Instead of repeating myself, let me go back to this primary formula that everyone knows. So you remember that formula? So that is our primary formula. Okay, margin of safety. Okay, I've shown that. 30 seconds. I've been asked to go back, so I've just gone back. So we are saying margin of safety in units is budgeted sales units minus break-even point in units minus break-even point in. So what is margin of safety? We have said margin of safety is the excess units that gives you a profit. Now, if you go to my notes, by the way, the notes are available in the office, but the notes are available to Minicofin normally pays for Minicofin sponsored students to get textbooks. So the notes are in the office for Minicofin. It's the same notes that you have in soft copy. So, but Minicofin sponsored, you must collect the hard copy. You must collect the hard copy. So if you can get time, come to the office and collect the hard copy. So what are we trying to say? Margin of safety is the excess units that generates a profit. I was saying that in the notes, if you read the notes, I've said that margin of safety is the units by which sales must drop before an organization starts making a loss. It is the same concept. The number of units by which sales must drop before a business starts making a loss. The number of units by which sales must drop before a business starts making a loss. So I hope the person who was writing, you're finished. Now, what we are saying that in this case, we want to get this. That is the sales units to achieve target profit. We want to get that sales units. If you want to make sales units the subject, what will you do? I'll again copy that so that I save time instead of retyping. So look at what I'm doing. Be careful, please. So if I want to make sales units the subject, the first point is to transfer the fixed cost across the equal sign. Before the equal sign, it is negative. When it crosses the other side, it becomes positive. So is equals to profit plus fixed costs. I'm just trying to go slowly. So that is selling price minus variable cost times sales units is equal to that. So again, if I go step by step, I'll do this. I'm just trying to say, okay, so I'm here. So I hope everyone has understood that point. I've just crossed the fixed cost across because I want to make what is in red the subject. Sales units to achieve target profit. So I've already done that at that point. So if I want to make sales units the subject, what I'll do is that I'll divide both sides by sales units. Sorry, copy, paste. I'll divide both sides by this. I'll divide both sides by that so that I remain with only. So when I take these, I divide by that. Across the equal sign, I must also divide by the same. So I'll divide by that also, so that I remain with only sales units in one side. So this, and that will cancel out each other. So those two will cancel out each other. they will cancel out each other. So if they cancel out each other, I'm trying to reduce the font size. So when they cancel out each other, we'll now remain with sales units. Sales units is equals to profit plus fixed cost divided by selling price per unit minus variable cost per unit, of course, per unit. And that is the formula. That is the formula. Therefore, that is what I wanted to write. Therefore, sales units to achieve target profit is therefore sales units to achieve target profit is, that is the formula. So how many formulas have we learned? We have learned 4 formulas. That is the formula that we've learned. So again, I'm giving you time. So the most important is not these ones. These ones, they just help to illustrate. So those ones, they just help to illustrate. So those ones just help to illustrate. The most important point is this last one, that one. This one is the most important point. So sales units to achieve target profit, that is how it is calculated. Always read exams questions carefully. I want to look at around 3 or 4 examples, just quick examples. So maybe I'll look at 3 examples. So I'll look at example 1 in the notes, and also we'll also look at 2 past paper questions. If we cover these, it's okay for us. So let us look at that to enable us practice. To enable us practice. So let's look at example 1 in the notes and also some 2 past paper questions. So refer to Excel sheet. So refer to Excel sheet. You know what I mean by that. Refer to Excel sheet. So we want to go to our Excel sheet so that we can start calculating. We can start our calculations. So if I share a new screen, I hope everyone is following. This is just one of the many requirements. So if I have that question, let's read it carefully. We take a short time. I'm seeing it's almost 45 minutes since we started. Arrow Limited manufactures product L and wishes to achieve a profit of 20 million. The following information relates to product L. Selling price per unit. So maybe I can have more requirements here. Selling price per unit, variable cost has been given, fixed cost, budgeted sales units has also been given. Required, calculate the sales volume required to achieve target profit. I can create everything we have covered instead of answering only that. So I can look at everything that we have covered. What is the first item we have covered? Contribution, CS, let me just abbreviate it, ratio. So CS ratio, we have said the formula is selling price per unit minus variable cost per unit, of course, times 100, everything divided by selling price per unit. 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 So divided by that. Take note of that, please. Take note of that. So the point is just remember the formula and everything will be okay. So if we just remember the formula, so that is equals to, look at what I'm doing, is equals to selling price is 20 minus variable cost is 12, of course, times what? 100, and everything divided by selling price is 20. So don't you see how these things are straightforward? That is why I was saying it is the easiest topic in management accounting. The easiest topic in management accounting. So that is equals to, let's just see, 20 minus 12 divide by 20. What does it give you? 0.4. When you multiply by 100, it gives you 40%. That is CS ratio. That is CS ratio. That is requirement number 1. I hope the speed is okay. So just look at the figures the way I've picked them before we go to requirement number 2. So requirement number 1 is CS ratio. If you have been asked, selling price per unit minus variable cost per unit divide by, sorry there, that is not 100B, it is 100%. So that is what you get. So CS ratio, selling price is 20 minus variable cost is 12 divided by 20 times 100. Requirement 2, let us look at BEP in units. BEP in units. So BEP in units, we learned that it is fixed costs divided by selling price per unit minus variable cost per unit. So that is how we get it. So that is equals to your fixed cost. You can see there is 100,000. Your fixed cost is 100,000. Divide by selling price is 20 minus variable cost is 12. So what do you get? So the answer will be equals to, so of course, sorry. So the answer will be equals to, 100,000 divided by 20 minus 12, close the bracket, you get your answer. So your answer there is, okay, let me use commas. So I'm just trying to see what I can do. So that is what we have. So, and the answer here you get is what? Units. So BEP in units, that is how you find it. BEP in units. I think they are fairly straightforward. Let us just move on so that we attempt as many questions as possible. So BEP in units, of course, it is fixed costs divided by selling price per unit minus variable cost per unit. Number 3, we look at BEP in revenue form, in Rwandese francs or in dollars. This question was in dollars form. So BEP in, so we have said the formula is BEP in units times selling price per unit, which is equals to BEP in units is equals to 12,500 times 20, which is equals to, if you can get me, is equals to 12,500 times what? 20. So what does it give you? 250,000. 250,000, of course, Rwandese francs or dollars. whatever you get there, Rwandese francs or dollars. But we said these can also be calculated as, or we said you can also calculate it. So still number 3, we said BEP in France can also be calculated as, we said fixed costs divided by CS ratio. CS ratio. So it can also be that, divided by CS ratio, divided by CS ratio. So that is fixed cost is 100,000, if I'm not wrong. CS ratio is 40%. So it's 40%. So that will be equals to, look at this, 100,000 divided by 40%. What do you get? 250. Do you see it's the same answer? So you can use whichever formula. It gives you the same. I'm repeating. BEP in France can either be this or that. So you just choose the one that is easier for you to remember. The one that is easier for you to remember. So either BEP in units times selling price per unit, or fixed cost divided by CS ratio. Remember, we had already calculated CS ratio. So choose the one that you can easily remember in exams to get it. So that is BEP in France. Next, number 4, we can look at margin of safety in units. Margin of safety in units. We said is equals to budgeted sales. Budgeted sales is also called target sales. Budgeted sales units minus BEP units. So which is equals to, budgeted sales units is equals to, let's see. Budgeted sales units is equal to 16,000. You can all see it there. So 16,000 minus BEP is 12,500. You can see 12,500 in what we have just calculated. 12,500 is there. So that is equals to 16,000 minus 12,500. So is equals to 3,500 what? Units. So that is margin of safety. Margin of safety. That is margin of safety. It is again just about remembering the formula. Number 5, we can look at margin of safety as a percentage. Margin of safety as a percentage. We said the formula is budgeted sales minus BEP, of course, everything times 100 divided by budgeted sales. So what am I doing? Let's see what I'm doing. Budgeted sales is 16,000 minus 12,500, of course, times 100, everything divided by 16,000. Budgeted sales. 16,000 divided by 16,000. You divide by 16,000. So what do we get in this case? So margin of safety as a percentage, you look at what I'm getting here, is equals to 12 minus that is the same as that, divided by 16. So what do we get? So we get 22%. 22%. So that is the margin of safety. Margin of safety is 22%. Margin of safety is 22%. So that gives you margin of safety. Margin of safety. Margin of safety. 30 seconds before we go to the last one to absorb what we have covered there. Okay, I hope you've gotten that. So next is, lastly, sorry for that. So lastly, number 6 is sales units to achieve target profit. Sales units to achieve target profit. We said sales units to achieve target profit is equals to profit plus fixed cost divided by selling price per unit minus variable cost per unit. That is what we learned. So that is what we learned. So that is equals to profit. Let's see here. Let's see. Calculate the sales volume required to achieve target profit. Profit is 20,000. So to achieve target profit of 20,000. So 20,000 plus fixed cost is 100,000 divided by selling price is 20 minus 12. So whatever we get there. So what do we get? So in this case, somebody can help me get the answer here. So it's equals to, let's see, 20,000 plus 100,000, everything divided by into bracket 20 minus 12, close the bracket. You get your answer, 15,000. What does that mean? If you want to make a profit of 20,000, you must sell 15,000 units. I'm repeating. If you want to make a profit of 20,000, that means, this means that in order to make a profit of what? Of $20,000, you must sell 15,000 units. That is the interpretation of that. This means that in order to make a profit of 20,000, you must sell how many units? You must sell 15,000 units. So that is the interpretation of that. Sales units to achieve target profit is profit plus fixed cost divided by selling price per unit minus variable cost per unit. The profit is 20,000. The fixed cost is 100,000 divided by 20 minus 12 to give you 15,000. So this means that in order to make a profit of 20,000, you must sell how many units? 15,000 units. Margin of safety of 22% means Out of sales that you make, 22% of sales is what gives you profit. 22% of sales gives what? Profit. So this means 22% of sales made is what gives what? Profit. 22%. So what does the first one mean? The first one means 3,500 are the units that give a profit. Are the units that give a profit. I'm just trying to interpret what I've been asked by somebody to interpret. So those are just different interpretations. Different interpretations. So what is that? Here, what is the interpretation? 12, when you sell 12,500 units, comma, you don't make any profit or any loss. Therefore, you must struggle to sell more than 12,500. So when you sell 12,500, you don't make any profit or any loss. Now, what I was saying is this. There is example 2 that I want you in your free time to solve it. Example 2 from the notes. This is example 2 from your notes. So example 2 from your notes. So calculate for me everything using that example so that I go straight away to past papers from the notes. So you will calculate for me that example 2. So have this as an assignment so that we save time. Have that as an assignment. So let's move on. So interpretation of sales CS ratio, this is like gross profit. But when we are using variable cost, we call it contribution. Remember, contribution is sales minus variable cost of sales. So which means the contribution margin is 40%. So this is called contribution margin is 40%. That is the interpretation. You know, in absorption costing, we always use gross profit. In marginal costing, we use contribution. So 40% means contribution margin is 40%. It's like the gross profit margin. Contribution that you make is 40%. That is contribution margin is 40%. It is the profits in quotes. The profit margin in quotes. Profit margin in quotes. So that is the interpretation of every item there. Every item there. I hope we have taken a lot of time there. So remember example 2, you have to attempt it. So let's look at June 2015, question 4D. June 2015, question 4D. Question 4, part D. So in order to solve it, we will look at solution here. I'll only answer the question we have been asked. Part D. Consider the information provided below. Raw materials, 160,000. Direct labor is 100,000. Direct expenses, which are also variable, of course, 50% of prime costs. 50% of prime cost. Sales price is 500,000. Fixed cost is given there. Hey, why were these people very generous in marks? 5 marks is a lot for this question. I could not have given 5 marks if I was the one setting. I could have given only 2 marks. So determine the break-even point in what? Units. And then determine the number of units to be sold to make a target profit of 100. Now, in order to answer that question, In order to answer that question, break-even point in terms of what? Units. In terms of units. We have all said break-even point in terms of units. What have we said? Is fixed costs divided by selling price per unit minus variable cost per unit divided by variable cost per unit. Please understand me there. Understand me? Now, we need to find, first of all, what is your fixed cost? Fixed cost is equals to 3585 is equals to 3585 000. 3585 000. So maybe let me work. Okay, so that is fixed cost. Fixed cost is that. Next, selling price per unit is equals to, I'm just writing them so that I just pick the answers. Selling price is 500,000. So 500,000. Next, variable cost per unit. Please take note of this. Variable cost per unit is equals to, look at what I'm doing. Raw materials is equals to materials plus labor plus direct expenses. Direct expenses. So this one will be equals to, so that one will be equals to materials. Just allow me to be slow so that we understand. Materials is how much? 160,000. Next we have labor is 100,000. I hope everyone sees that. Labor is 100,000. Direct expense is, allow me to push this so that I have space. Direct expense is equals to 50% of prime cost. 50% times 260. How do we get 260? 260 is 160. So let me move that also. So it is 160 plus 100. So that is equals to 50% times into bracket 160,000 plus 100,000. Sorry. I'm seeing where we, yeah. So it gives you 130. So what is the variable cost per unit? Variable cost per unit is therefore equals to, variable cost per unit is therefore equals to, I'll just auto sum that, equals to that. So our variable cost per unit, whatever you get there, that is variable cost per unit. Therefore, we can calculate BEP. BEP in units is equals to, BEP in units is equals to fixed costs. Your fixed cost is that divided by selling price is 500,000 minus 390,000. So what do you get? So BEP is equals to, look at what I'm doing, this divided by selling price minus variable cost. You get your answer. What? What have I done wrong? Is equals to selling price divided by, fixed cost divided by minus that, close the bracket. Somebody to help me the answer. What have I done wrong there? Thank you for what you are saying, but I'm comparing. You see, if the selling price sales per unit is 500, that is what influenced my choice. If the sales price per unit is 500,000, it is difficult for this to be per unit. 200. So the ones that are close to 500 is what I've used. So I've taken these, I'm assuming they are per unit, because sales price per unit is even more, 500,000. It will be unrealistic to say that variable cost is 800 plus 200, 1,000. Variable cost is 1,000 and sales price is 500,000. That will be unrealistic. It will be unrealistic. So somebody to help me. I don't know what is the problem with my functions. Maybe let me see here. So is equal to this divided by 500 minus 390. What is the problem, IT people? Can you help me? So you get that. Okay, let me just type manually to see if I can get it. 3585000 divided by 500,000 minus 390, close the bracket. Yeah, it gives you 32.5 units. Those are the number of units that break even. Those are the number of units that break even. So if we round off these, it gives you 33. If you round it off, it gives you 33 units. 33 units if you round off. So remember, that was requirement 1. That was requirement 1. Requirement 2. You can even get BEP in revenue, but I've not been asked. Determine the number of units to be sold to make a profit of 10,000. So requirement 2, number of units to be sold to make a profit of how much? These people are making a very small profit. So in this case, we will say sales units is equals to, what did we say? You take profit plus fixed costs. Of course, you get your answer divided by selling price per unit minus variable cost per unit. Now look at this. Profit is 10,000 plus, please understand me, 10,000 plus fixed cost is, wow, 3,585,000, and then you divide by 500,000 minus 390,000. This is why I was telling you people, this variable cost, this must be the variable cost per unit, because 390 is very close to 500,000. Very, very close. So what do we get? Somebody to help me? Is equals to 10,000 plus 3,585,000, close the bracket, divided by, open a new bracket, 500,000 minus 390,000. Close the bracket, you get your answer. Your answer is also what? 33. So 33, exact. This one is exactly 33, but this one was 32. Remember, this was, sorry, this was 32.59, but this one is 33. If you want to make a profit of only 10,000, you need to sell 33 units. Oh, thank you, Jean. I've seen where I made a mistake. So those are the number of units to give you what? That kind of a profit. Any question? That is what you are to answer, and it was 8 free marks. I call these free marks because it is very easy to get those 8 marks. Maybe the last question here, okay, just 30 seconds to understand, 30 seconds to understand, please. 30 seconds. Sometimes I forget and move fast. Remember, there is a part of that question I've ignored. It will be an assignment. Discuss, when we finish, I'll ask you to give the limitations, disadvantages of CVP analysis. You give the disadvantages. That one you can search on. Assignment is to what? List the disadvantages of what? CVP analysis. This one you can even Google so that we don't take a lot of time there. So disadvantages are what are called what? Limitations. Limitations. So please make sure you Google on that and write on it. So please take your time. Ignore part A for now. We have still not reached part A. Part A is reading with the help of graphical illustration, distinguish between accountant's model and economist's model of CVP. That one we'll be looking at in our next class, not today. So let's read through part B. Take your time. Take a minute to read through part B. Take a minute to read, and then we will do it together. Take a minute to read, and then we will do it together. Okay, the question reads, Safeway Transporters Limited operates a fleet of buses along Gisagara-Kamonyi route. The company charges 6,000 per passenger per trip, and each bus trip averages 65 passengers. So every trip, this company charges a price of how much? 6,000 per passenger. And each trip averages, in every trip, we have how many passengers? 65 passengers. Now, SW, that whatever, incurs a variable cost of 3,200 per passenger per trip. And its annual fixed cost is estimated as 146 million. Since its incorporation, SWTL has been loss-making, but recently it hired a new station managers who are expected to turn around this performance. Budgeted estimates for the next accounting period indicate that SWTL is targeting a net profit after tax of 24 million and intends to make a total of 1,100 trips. SWTL pays corporate tax per annum of that. So requirement 1, determine number of trips that SWTL should make in order to break even with the above target what? Profit. So in order to break even, so that is requirement 1. So we are looking at part B requirement 1. So trips to break even. Trips to break even. So trips to break even will be equals to, please understand me there. So trips to break even, it will be fixed cost, of course. Our fixed cost is, yes, when I say that, it's a past paper question, Frank. I've written here June 2018 question 1. That is past paper. That is past paper, Frank. Thank you, Anastasia, for reminding him. So here we are, June 2018 question 1, A and B, it's past paper. So remember, it is fixed costs divided by selling price minus variable costs. Okay. Take note of this, please. Take note. Remember, you are being asked the fixed cost made, the fixed cost that these people make, the fixed cost that is made is the number of trips that should make in order to break even. So look at this. What is our fixed cost? Fixed cost is equals to, look at what I'm posting. So fixed cost is equals to, okay, I saw it somewhere. Somebody to help me. Annual fixed cost is 146,000. 146 million, sorry. 146 million. Now there is a problem here. We need to find what is the selling price per what? Per trip. Per trip. We'll also need to find what is the variable cost per trip. Variable cost per trip. So to get the selling price per trip, this was a bit tricky. What you do is this. You find your selling price. Your selling price is 6,000. but that is selling price per passenger, not per trip, per passenger, times 65 passengers to give you per trip. Please understand that. Here, variable cost per trip is equals to, what is variable cost? 3,200 times 65 passenger per trip. Passengers per trip. So selling price per trip, not per passenger, per trip. That is where the point was hidden. So this is 6,000 times 65. It gives you 390,000. This other one is 3,200 times 65, whatever it gives you. So BEP in terms of trips, not in terms of passengers, in terms of what? Trips, is equals to this 146 million divided by 390 minus 208,000. There, I know many people could have gotten it wrong because they could have just used selling price per passenger. But it was per, because you have been asked the number of trips. So that is equals to 146,000 divided by 390 minus 208. You get your answer. So how many trips? Trips. So these people must make how many trips? That number of trips. So if we round off, this will give you, let's call it 803 trips. But the exact one, let's work with the exact. That is the exact number of trips to make in order to break even. Okay. How many, if I asked you, how many passengers must be transported? Maybe if I added, how many passengers must be transported to break even? How many passengers must be transported? I'm just adding this to break even. So how many passengers must be transported to break even? It will be 802.20 times 65. It will give you the number of passengers to be transported to break even. So this times 65, it will give you 51 passengers. So in order to break even, you need in a year to have transported those number of passengers in order to break even. In order to break even. So that is part 1 of the question. Part 2 of the question, what was it asking you? The other ones should now be easier. Break even revenue assuming no target what? Profit. Break even revenue. So part 2 of the question is break even revenue. Break even revenue is equals to BEP times selling price per trip. So that will be equals to 802.2 times selling price is 390. Whatever you get. So this one will give you 802 times 390. So that was the answer. Again, here many people could have got it wrong because they could have used selling price per passenger instead of per trip. So the key point there was per trip, per trip, per trip. Number 3, margin of safety in revenue at the budgeted activity level. So what was the budgeted activity level? How many trips? Intends to make a total of 1,100 trips. So margin of safety. So number 3, margin of safety. Margin of safety is equals to target sales minus BEP. So margin of safety is target sales minus BEP, which is equals to target sales is 1,100 trips minus BEP is 802.2 trips. So that will give you, so what answer will it give you? 1,100 minus 802, 802.2. So what does that give you? 298 what? Trips. Trips. Margin of safety. You can, I'm just answering what we were asked there. That is margin of safety. What is the last question? Yeah, that was the last question. So again, take your time to absorb, please. Take your sweet time to absorb that. Remember, we were not asked for this. We were not asked for what I've put in yellow. I've just added that to explain. We were not asked for that. So take your time to understand that. Take your time. Take your time. I'll share the workings. I'll share the workings. I'll share the workings. Now, if we may wind up so that I don't take your time. Now, look at where we were. We said, just look at where we were. I hope everyone is seeing PowerPoint. So if you are, we said you can get this CVP by use of formulas. So we have been looking at formulas. In the next class, we'll get the CVP by use of what? Graphs. So here CVP analysis by use of formulas was part A. So when we come next time, we will look at part B, CVP analysis by use of what? Graphs. CVP analysis by use of graphs. CVP analysis by use of graphs. That is where we'll start the next class. CVP analysis by use of class. So the next class will start from there. But before I say that, there are 3 graphs. There are 3 graphs we need to know in order to look at CVP analysis. Number 1, graph 1 is called traditional break-even chart. There was a question in one of the past papers on that. Number 2, we will look at what is called contribution break-even chart. Number 3, we will look at what is called profit volume chart. Profit volume chart. So that is where I want us to start the next class. So when is our next class? Next week on Wednesday. What date? What is the date? Somebody just to, I hope this weekend we are not meeting. So next week on Thursday, not Wednesday. I'm used to saying Wednesday. So next class is next week on Thursday. Somebody to give me the date to check the calendar. On Thursday is what date? Somebody to check for me the date, please. Eleventh March. Thank you. 11th March. So our next class is 11th March. 11th of March 2021. That is our next class. So let's meet in the next class. Have a good night. So that is our next class. So that will be our next class. Keep time 11th at that, so that we finish this and start a new topic on that 11th. So we will finish on these charts and then we will start a new topic. So those are the 3 charts we'll start with in that class. Have a good night. Meet you on 11th. Thanks for attendance of today's class. If you have not typed your details in the chat, type your details. Slide number 93. Okay, fine. Jean Paul, in this case, the reason why I didn't use 800 and 200 given, okay, unless I go back, re-ask me that question in the next class. The reason why I looked at 500,000 and I compared it to 390,000. 500,000 if it is the selling price per unit, unless the examiner made a mistake. 500,000 is the selling price, which means variable cost must be close to 500,000, unless there was a mistake in that. So if there was a mistake, we could have taken 500,000 divided by the number of units, if the 500,000 was the total sales. But you have been told 500,000 is selling price per unit. That is why I used 390,000 to be the price also per unit. Thank you. Have a good evening. See you next time.